Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We've got 1 hour to go until the market close. Let's check in on where the major averages are trading at the moment here. Seeing a little bit of a lift across the board here with the Dow up about 1/3 of 1%, the S&P up 0.4, the Nasdaq up by nearly 0.75 of 1%. President Biden today formally unveiled new targeted tariffs on Chinese goods. Yahoo Finance executive editor Brian Sozzi spoke with President Joe Biden after the announcement was made.
Mr. President, thank you so much for joining Yahoo Finance. It's an honor to be inside the White House. So you and your administration have taken strong action against China. 100% tariffs on China EVs, 50% tariffs on semiconductors from China. Now, a lot of economists would say this could unleash inflation. How do you convince the American public that this will cause inflation, and why so targeted with the tariffs?
Look, China is fundamentally underrating their entire industries. They're just over. They flood a market. They pay whatever it takes to flood it. They make sure to put everybody else out of business and they take over. Or, for example, even if you want it for the longest time, if you want to do business in China, guess what? You have to have a 51% Chinese owner. You have to make sure that you're, in fact, going to make sure that they have access to the intellectual property. It goes on and on. It's about being fair. And look, it's about saving American jobs. Because if we allow them to continue what they're doing, to flood the market with EVs that are incredibly cheap, they're not making any money on them, deliberately doing it to put other people out of business. So we're going to protect the American auto workers, we're going to protect American steel and American aluminum.
Do you believe this will lead to retaliation from China?
Well, I'm sure China will talk a lot about it, but the fact is China already is what you might say way over their skis on this. What they'll do, I don't think it'll lead to any international conflict or anything like that. But I think they'll probably try to figure out how they can raise tariffs maybe on products that are unrelated.
Lastly, Mr. President, over 15 million jobs have been created under your watch. The unemployment rate under 4% for 27 straight months. The stock market at a record high. Why don't households feel wealthy right now?
Well, first of all, if you look at the report coming out of the Michigan survey, over 60% of the people in America feel they're personally in good shape. They're personally in good shape. But they look out and they say the rest of the world's not in good shape. Other people aren't in good shape. I think inflation has gone slightly up. It was at 9% when I came in, and it's now down around 3%. But the fact is that I think people are just uncertain. And that's why we got to be steady, stay the course, and continue to produce these incredible jobs. And by the way, the pay for the jobs are outpacing the inflation rate they're paying. We're going to be able to deal with this. It's going to take a little more time, but we're just focused on it.
Mr. President, thank you so much. We appreciate it.
Thank you, man.
Thank you.
Yahoo Finance's Rick Newman is joining us now with his takeaways on the China tariff news today. Rick, so the headline of your column, by the way, which I would urge viewers to check out, I think kind of sums it up. Trump called himself a tariff man. Biden looks like one now, too.
He does. Now, there's a continuum here, which is that the whole political world in the United States now is tough on China. I mean, it didn't used to be this way. I mean, this is not the way most people thought during the Obama administration, for example, when we were, competing with China, but we were enjoying all the cheap products that they sent our way. And that was deflationary, by the way. I mean, one of the reasons we had such low inflation for basically a 20-year period was all this cheap stuff from China and other places. That has now completely changed. And what Biden has done is affirm that this is a two-party pivot against China economically. Now, there are some differences here. So Trump did a scattershot approach with his tariffs, and he just basically put tariffs on, it was about half of all Chinese imports, which is way more than what Biden has done here. So Trump just put tariffs on this huge range. It was literally thousands of product lines. And Biden is like 15 product lines, and it really is targeted. You used the word targeted in the intro. It really is. And this does line up with other Biden policy areas, which is build out semiconductor supply chain here in the United States, build out green technology supply chains here in the United States. There are a few medical items on there because because of what we learned during the pandemic, which is all this stuff came from China. We couldn't get masks and gloves. So Biden has said, well, we need to just build these assembly lines here in the United States more. So that's mainly what he's trying to do. The question is, are we done? Because we're now in a one-upmanship situation between Trump and Biden, and it's not hard to imagine that whoever wins, or even throughout the course of the election for the next 6 months, somebody might say, well, this guy did this, I'm going to double it, I'm going to triple it. We might see Trump coming back and sort of upping the ante.
Well, and for example, Trump has already said, well, he's putting 100% tariff on Chinese EVs. I would put a 200%.
That's right, yeah.
He said things like that. Again, just as a matter of perspective here, the amount of goods being tariffed under the Trump tariffs was $300 billion.
Right.
The amount here is $18 billion. Right. And I know you've done a little bit of looking into the economic impact of the Trump tariffs. Talk to us about that and what the forecast is for the economic impact of these.
There have now been a variety of economic studies into the effect of the Trump tariffs. As recently as, within the last month, Goldman Sachs did a report on this because they're trying to say, well, we're going to have more tariffs. What happened the last time? There's just not any evidence that the tariffs were good for the U.S. economy. They may have been good for Trump politically. It's possible that he got a little bit more support than he would have otherwise gotten by convincing certain voters in certain targeted industries that he's looking out for you, the steel and aluminum industries, for example. But those tariffs raised U.S. prices. There are a number of studies that say that. And there was no manufacturing renaissance in the United States under Trump. There's just no, and that's what he said. He said he wanted his tariffs to do two things. Number one, he just wanted to reduce the trade deficit because he hated the number. The number was too big, but the number itself it doesn't really mean anything. And then he wanted to reestablish U.S. manufacturing, and there's just no sign that happened under Trump. It does seem to be happening under Biden. And not because of tariffs, but because of the bills that he has signed into law that contain incentives for building this stuff in the United States. That's tax breaks that go to the bottom line of private sector companies that start building these, green energy factories, electric vehicle factories.
But it'll take a while.
Yes, but we're already seeing the factories under construction. We've been talking about semiconductor plants in New York, in Ohio, and Arizona. Those are going to take a while to build, but the fact that they're getting built means private sector investors are putting the money in because the incentives that Biden signed into law make it more profitable for them to do it. So that when you see the private sector money being committed, that tells you this is coming.
How much do you think of this, and you hinted at this, Rick, is just raw politics in an election year, Biden trying to secure votes in key swing states?
Most to all of it. So economists hate tariffs. Most economists hate tariffs because they're inefficient. They create inefficiencies. So you're starting to get, the government is starting to help private investors determine where to deploy their capital, right? So you're changing the equation in terms of the return on investment in capital. However, there was a very real problem in the United States, which we now call the China shock. We didn't know this was happening as it was happening. But when we finally got the economists doing the research, it is very clear that all this Chinese manufacturing that happened starting when China came to the WTO, which is 2001, really did take millions of U.S. jobs overseas and did hollow out significant portions of the heartland, in particular the so-called Rust Belt. The data now makes it very clear that happened. And guess what? U.S. politicians did nothing about it. We had very ineffective policies in place. That there were some retraining programs for people when the factory leaves. They didn't work. And that's why Trump got elected. That is the number one reason Trump got elected in 2016, because he appealed to those people. He called it American carnage. When he said, make America great again, what he meant, or what those people heard, was bring those jobs back. That's not easy to do, and it might be impossible to do, but we've now got politicians in both parties are now going.
It is so interesting, Rick, that I think you were discussing that in that, correct me if I'm wrong, but you seem to be suggesting Trump was kind of a lone voice for a period in this criticism of free trade, or certainly one of the few. It is now consensus.
There are a bunch of areas where Trump had the right idea for the wrong reason.
Well, and this is one of them.
What
he did did not result in bringing those jobs.
But I'm saying that
back,
criticism,
right?
That's correct.
But the point,
and it was even worse because China put tariffs on U.S. agricultural products, and we had to bail out our farmers because they could no longer sell stuff to China.
But don't you think, Rick, there was a shift in narrative there? Who was with Trump when he was saying that? I mean, that did seem to be a minority opinion at one point that has now shifted, as you point out, a real one point where right and left seem to come together.
So I think Trump does have a knack for putting his finger on something that is wrong. So he figured out, he was right, that American carnage, that people reacted to that because they saw it all around them. The factories disappeared and there are no jobs left. People saw that, and he appealed to that. His prescription was wrong. So he saw it, and yes, sure, give him credit for highlighting that and figuring that out, he just does have a knack for these things somehow, but a lot of times the prescription is wrong. So yes. Right. What started, it's kind of like Biden's doing Trump 2.0. He's trying to, new and improved, try to do it better than the first time around. And he might. I mean, whether you like tariffs or not, his approach is fairly shrewd.
All right. Well, we're going to talk much more about this.
Yep.
Rick, thank you so much for your perspective
Thanks,
there.
guys.
Well, as President Biden unveils new tariffs on Chinese goods, economists eye the potential effect of this response, especially as we get closer to the November election. In an exclusive interview with Yahoo Finance, President Biden explained the targeted move.
China is fundamentally underrating their entire industries. They're just they flood a market. They pay whatever it takes to flood it. They make sure to put everybody else out of business and they take over. Or, for example, even if you want it for the longest time, if you want to do business in China, guess what? You have to have a 51% Chinese owner. You have to make sure that you're, in fact, going to make sure that they have access to the intellectual property. It goes on and on. It's about being fair.
Joining us now, Semaphore founding editor-at-large, Steve Clemons. Steve, thank you for being here. President Biden says it's about being fair. You probably heard we were just talking to Rick about this idea that Washington has kind of come around to tariffs, even if economists largely haven't. What are you hearing in terms of the response to this latest round?
Well, I think politically, those that are on the Republican side of the aisle are thinking that Biden is still out of touch with the economy. But there's just no doubt that, Rick is right, that this is not just continuous in a sort of a more targeted area of sanctions. It's a real doubling down on a comprehensive industrial policy strategy, which we haven't seen in a long while in the United States. You can even say the words industrial policy during the Obama administration when you had folks bailing out the auto sector. So the United States has come around. There's a consensus between both parties that something has to be done to restore American manufacturing excellence and technology investment and whatnot in the country. But what I find really interesting, and they're missing parts to this equation, which I think some politicians and a lot of economists are going to pull apart, is that it took 2.5 decades for people to see that China was, a kind of economic predator in some areas. And, I drove a BYD test car in 1996 when I traveled with Senator Jeff Bingaman to China. So one of the early cars, what is that, almost 30 years ago, while much of American industry was offshoring at that time to China. And so now we're waking up and saying, wow, we need an industrial policy now. So it does shock a little bit. And what one worries about is that historically we have got a mixed record when it comes to this sort of thing. Sometimes high tariff walls produce inefficiencies here. And my question is, what are you going to do with the American industry to benchmark their growth and progress so that you're not actually protecting lethargy and inefficiency and lack of innovation and watching companies take that money and investment they have and buy back stock shares as opposed to what Rick talked about was actually investing in themselves. So I'm hopeful, but I think we ought to be very cautious and skeptical that this is going to basically turn around the U.S. manufacturing sector right away.
Another issue, Steve, I want to get your take on. President Biden did tell Yahoo Finance today he expects retaliation from China for these new tariffs. I'm wondering if you would expect retaliation from Beijing and what you think that might look like, Steve.
Well, of course I do. And I think that they will try to put pressure on us in some way. But I think, so far, if you look at China's remarks, they've been measured, cautious and careful. China is very dependent on, U.S. consumers in the U.S. market, just as we are very dependent on China for a lot, by the way. And one of the areas I'm worried about, and we'll have to see how it goes, is as tensions ratchet up with China, not only in the strategic technology sectors, but geopolitically and militarily, as they ratchet up, does China shut down its supply of critical materials that we need for our EV industry? We're pretending like we've got all that stuff. China controls about 80% of world supplying critical materials and critical minerals and metals today, and that's a really big problem for the U.S. industry if it were just decide to pull the plug on all that and say, good luck with your EV and green renewable side. And the one thing that has to be said, and I need to say it here, is it's not all just economic. There is a positive environmental dimension to Chinese dumping of environmentally positive technologies and whatnot out there. I'm not saying I endorse dumping, but we took a long time to identify that as a strategic sector. We certainly missed the boat on solar panels for a very long time. And what we're really saying is that for U.S. industry to compete and participate economically and be a viable player when it comes to green energy transition, we've got to go through this process. But there's no doubt it's going to have an impact on our climate performance in that arena as well. That's another part of the argument that a lot of people have been missing.
Well, Steve, just to rewind also to something you were talking about how much of these sort of vital minerals, rare earth minerals, lithium for that matter, although it also comes from other countries that they control.
Sure.
There's no imminent threat that they're cutting off supply, just to be clear here. There would need to be quite a few more steps between this new list of tariffs and that kind of an action happening. And in fact, it seems like China's...
I would hope so. But
come on, they would telegraph it a little more before it got to that point.
Well, I don't know, but you got to be careful, because if you get into more zero-sum competition between nations over strategic industries, and we're saying, hey, we're going to triple the price of your EV cars, they could find ways to sanction, at least raise, we could end up with an interesting kind of trade war. Look, I don't know if it's going to happen or not. I think we need to be prepared and sometimes think about what the worst might look like. And so as you're trying to shore up an industry, in the United States, that's part of the green energy transition, about building jobs and capacity in the United States during a political season, you've got to ask, what is the other side going to try and do to undermine that vision? And in my mind, one of the natural areas that they would go to are those supplies that they're supplying into that U.S. industry that wants to protect itself. I'm not saying it will happen, but it would be logical to worry about that.
Well, it seems as though in this particular case, the Chinese response has been somewhat muted, right?
Right. It's been measured so far. They've known this was coming, and we'll have to see what's next. What I worry about is the overall broad hyperventilation about China in a lot of other sectors, and the discussion, both about decoupling, which is crazy, and de-risking, which is perhaps more serious, about looking at these strategic sectors along the lines that Rick just said, rather than having a broad swath of a block, having a more narrowed side. And hopefully China sees that as something, not to overreact to. But in the United States right now, there is an allergy on all things China. And that they're our second, next to, I guess, Mexico, our next biggest trading partner in the world, about $750 billion of bilateral trade. So if you were to basically end that at some point, which we're in no chance of doing, it would create an incredibly global disruption in all sorts of ways.
Indeed it would. Steve, it's always good to see you. Thanks a lot.
Thank you.
We're just getting started here on Market Domination. Coming up, tariff fallout, more on the impacts both in the U.S. and China from President Biden's historic wave of tariffs. Plus, U.S. Trade Representative Katherine Tai spoke to our Brian Sozzi about those tariffs and why the administration chose to focus on the semiconductor industry. Plus, the meme stock trade, it's returning with a vengeance, but is it anything close to what we saw in 2021? We will tell you that and much more when Market Domination returns. Electric vehicles are a key focus of President Biden's wave of tariffs on strategic Chinese imports. Tariffs for EVs set to quadruple in 2024 from 25% to 100%. In an exclusive interview with Yahoo Finance, here's what President Biden had to say about this.
It's about being fair. And look, it's about saving American jobs, because if we allow them to continue what they're doing, to flood the market with EVs that are incredibly cheap, they're not making any money on them, deliberately doing it to put other people out of business. So we're going to protect the American auto workers, we're going to protect American steel and American aluminum.
Let's bring in Yahoo Finance's Pras Subramanian to talk more about this. Pras, what is going to be the effect of this? Because as of right, I mean, are there any Chinese EVs right now today sold in the United States?
There are. So
Okay.
Polestar makes their Polestar 2 electric vehicle in China.
I wasn't even thinking of Polestar.
Yeah, and they import that, and they probably pay about a 27.5% import duty. But now that's going to be going up to quadruple. Polestar got back to me and said we're evaluating what to do. We're going to figure out. We're still kind of deciding what's going to happen here. But that's a big problem for them if they need to sort of do this. Now they have a South Carolina plant that Volvo owns that they're going to build their Polestar 3 at. So they're going to try to avoid this tariff situation. But the Polestar 2 is under threat. But only 2% of vehicles sold, EVs sold in the U.S. for Polestars. So it's the vast majority of EVs are not going to be under this China EV tariff duties scheme. So that's not a problem right now. But down the line, you're not going to have these cheap EVs that are actually pretty good. They do pretty well. People love them in China. People in this country who would want a reasonably priced EV are not going to be able to get that unless they buy a used car.
So the issue is not in the near to intermediate term. There's no real impact on the U.S. auto industry because the volumes are just too low. This is more of a long-term issue, long-term play.
I think so. I think that's it's election year stuff. It's kind of a way down the line sort of situation. But there have been talk of the EVs coming that are built in Mexico by Chinese companies that they sold in the Mexican domestic market, bringing them here.
Oh, so that's interesting. So that's a way almost China assembles them in Mexico and then somehow skirts the issue.
Yeah, because it's part of the USMCA. So there's this idea of a back door, but other experts
Wouldn't
say...
Biden try to close that loophole pretty
quickly?
quickly?
Executive order or even
I would think that would be shut down pretty fast.
Legislation could do that. So they would shut it down, but it would be in violation of USMCA. So that's a tricky issue.
And it's interesting that we talk about Mexico because Steve Sosnick of Interactive Brokers was on the Opening Bid podcast with our Brian Sazzi yesterday morning, and he said he just got back from a vacation to Mexico, and there were BYDs everywhere, including taxi cabs. So there's, anecdotally at least, there's definitely some down there. What's interesting, and this is something Steve Clemons alluded to as well, is that on the one hand, the Biden administration definitely has pushed the energy transition, has pushed the green energy transition, and putting cheaper EVs into the U.S. market would help with that. So it's, there's a little bit of tension here.
Yeah, I mean, look at solar panels, right? I mean, I think, in my opinion, that's sort of a bad thing for the green movement in this country is that was a way to get people to harness the power of the sun. Cheap solar panels, there's nothing wrong with that. But it's going to compete against our products that U.S. companies make, which I don't even know are even that many in terms of volume, right? So
in part, there aren't that many in terms of volume because of the Chinese.
Chinese.
Right,
so
exactly.
You're absolutely right. It is
already the damage that's been done there.
Right. So you're right. It is the transition to green energy, green solar, or just a green movement here is going to be hampered by fewer electric vehicles coming from China. That's the net effect.
Interesting.
All right, thank you, Pras. Appreciate it. President Biden unveiling new tariffs on Chinese goods today in an exclusive interview with Yahoo Finance. President Biden talking about the potential retaliation from China for the tariffs.
Well, I'm sure China will talk a lot about it, but the fact is China already is what you might say way over their skis on this. What they'll do, I don't think it'll lead to any international conflict or anything like that, but I think they'll probably try to figure out how they can raise tariffs maybe on products that are unrelated.
Joining us now is Zach Cooper, Senior Fellow at the American Enterprise Institute. Zach, it is good to have you on the show. So, Zach, President Biden used to criticize tariffs. No more, he's on board. And I guess the big picture, Zach, the idea being we allow all these Chinese imports. That's a risk that jeopardizes American manufacturing, American industry. Give me your kind of big picture take, Zach, on today's news.
Well, I think your other guests have got this exactly right. Biden is basically taking a page out of the Trump playbook here, right? He's using tariffs in response to China. Many people thought that when Biden came into office, he'd actually wind back some of the Trump tariffs. And here, 6 months out from the election, you have the administration putting more tariffs on. So I think that's the big story. But maybe where I would differ a little bit from some of your other guests is that I do think there's a more near-term challenge from Chinese electric vehicles. You look at what's about to happen in Europe and has been going on in just the last year. You have a lot of Chinese electric vehicles flowing into that market. They could come here pretty quickly if the administration didn't act. And so I think they really were up against it. They had to take action pretty soon. And I think that's why they've moved now.
So, Zach, do you think that this then was the right move? I mean, as President Biden pointed out in our interview with him, it's about fairness. I mean, the Chinese, policy has been protecting its own for years now. And that's helped definitely the EV industry grow there. So, that argument, why shouldn't we do the same? Is that a valid argument?
I do think it's a valid argument, and it's true not just in EVs, but in several other areas, right? We know that there's a lot of Chinese overcapacity in some of the other areas that the tariffs were raised overnight. We see this in steel, we see it in aluminum and in others. So I do think this idea of reciprocity is logical, especially when it comes to trade issues. I would just add that at the end of the day, the Chinese, they're doing this in a huge number of industries where they say, we can take action to protect ourselves, but if you take action to protect yourselves, it's unfair, right? So they do this on social media where the US is talking about forcing a divestment of TikTok. Of course, none of the American social media companies are available in China, but that's sort of immaterial from Beijing's point of view. So I think it's a little bit of do as I say, not as I do from China on this issue.
Zach, I'm curious as well to get your take on how inflationary you think this policy decision is.
Well, there's been some data suggesting, this is basically $18 billion worth of tariffs. It's clearly inflationary. There's no question about that. But how inflationary is it going to be? Look, this is a pretty small amount of goods that we're talking about overall. And so I doubt, unless there's a really serious Chinese response, that we're going to see that much inflation. Certainly nothing noticeable like the kind of inflation that we've had over the last few years.
Let's linger on that unless for a moment, Zach, because right now we haven't heard any kind of outsized response from the Chinese. But, what, for example, would happen if President Trump won re-election and instituted the more broad tariffs that he has sort of talked about? I mean, in other words, what would need to be the steps to get from where we are now to a more serious trade war?
Well, I think the Chinese would probably have two different sort of steps on the escalation ladder. The first thing they might do, and I think we could see this week or in the next few weeks, is they could go after specific critical minerals, for example. So they've already restricted access to gallium, germanium, and graphite. We could see them expand that list out a bit further. So those would be a bit more targeted. And then you could see some broader actions, right? What they did in response to Trump, one thing that at least they thought was effective was to go after agricultural exports from the US to China, in part because it hits in the Midwest, and that's where this election is going to be decided in large part. And so I wouldn't be surprised to see them either threaten to go after agricultural exports from the US or actually to start limiting some of those in advance of the election.
Zach, I'm just curious, when let's say your friends and family, they ask you, Zach, what are the big differences at this point between how Biden and Trump, how they think about and approach China and trade? How do you explain that?
Well, I think this move by Biden was more defensive, right? They're worried about a huge flow of electric vehicles from China coming into the US that are greatly subsidized. On the other hand, the Trump approach was a bit more offensive, more focused on trying to force a behavior change on the Chinese side. That's really what the phase one trade deal was about. It didn't work, as Steve and some of your other guests have talked about, but that was the logic. And so I think the Biden approach thus far has been a bit more defensive, certainly when it comes to tariffs, more focused on investing in the US. Whereas the Trump approach, I think if Trump wins, Bob Lighthizer has been quite clear, he's going to use all kinds of leverage to try and force the Chinese back to the table. And so I would expect that you would see much higher tariff rates out of Trump if he's actually successful in November.
Zach, it was great having you on the show today for that insight and expertise. Appreciate it.
Thank you.
Coming up, we're going to check in the markets, and the latest meme stock rally here is GameStop and AMC are once again soaring in today's trade. Stick around. Much more market domination on the other side.
Welcome back to Market Domination. Stocks edging higher. The Nasdaq's on track for a record close. Jared Blickery is standing by to get you up to speed on today's action, sponsored by Tasty Trade. And is the Nasdaq the only one that's on track for a record close?
You know, it's going to be a nail biter, so I will get those figures and we'll have those ready in a few moments. What I just want to show right now is that small caps are leading the way. They're up by 1%. That's Russell 2000. Nasdaq, I'm going to show you that chart. It has been building on gains, and most of these gains have come in the second half of the day, so exhibiting some late day strength here. Interesting turnaround in bond land. We had the 10-year T-note yield up a few basis points, and right now it is down by 4 basis points. It has trended lower throughout the day. You can see that's at 4.44% right now. And then here's the sector action. Tech has been in the leadership position all day. Only 2 sectors in the red are energy and staples. And if you want to know where the action has been and the attention has been, it is with these meme stocks right here. Now, you're going to see GameStop up 57%. AMC up by a sizable percent as well. But some of the other names not jumping quite as much as we saw in prior episodes. Nevertheless, you can't argue with the amount of green that you're seeing behind me.
Thank you, Jared. Meme stock craze is back. GameStop and AMC are soaring again, but Wall Street says this time may be different. Joining us now with more on why this surge isn't like that 2021 meme stock craze is Yahoo Finance's very own Josh Schaefer. Joshua.
Yeah, guys, so that's sort of been the prevailing take from different Wall Street strategists, both that we've spoken with and just people producing research on the street that we get into our inboxes here, sort of breaking down overall. It doesn't quite feel like 2021. And there's a couple data points we can highlight with that. So Vantiv Research took a look at just retail net inflows that you see into these stocks, right? And when you take a look at Monday, we saw 15.8 million into GameStop, 37.5 million into AMC. When you compare that to 2021, in the peak of 2021, we saw daily inflows into GameStop of 87.5 million. So that's 87.5 million compared to 15.8 million. That is a big, big difference. With AMC, we saw about 170 million, and that's compared to 37.5 million. So quite simply, the flows aren't anywhere close to what we saw back in 2021. And then there's a couple just broader points that people have been bringing up too that I think are sort of rather intuitive to think about here. One of them just being, it isn't 2021 in the world anymore. And so maybe that's why this isn't going to last longer than maybe the 36 hours that it's lasted.
Meaning in 2020, people, pandemic, stuck at home, looking for some fun.
We're not sitting at home, hanging out.
Extra cash.
Watching a
Yeah, that's
live
another
stream.
point. Stimulus checks.
And
Right,
there's not the stimulus checks that just came. It's just not the same environment. And so when you think about how that maybe plays out in the market, again, maybe people don't just have the money to throw at something like this and the time to watch what the money's doing.
Well, and it's not just about the people who are trading, the retail traders who are trading this. The world has also changed in that hedge funds have wised up. At that time, you know, the Gabe Plotkin's of the world were really caught off guard by the force of this, you know, phenomenon. Now they're probably following, at least some of them are, you know, following along with it. And yes, there were some then who were doing that too, but they've wised up to this.
Yeah, no, the positions aren't nearly the same, right? For the level of a short squeeze that we saw, there isn't that kind of room to run when it comes to that. And you're right, Julie, a lot of people have been pointing out to, if flows are working how they think right now, hedge funds are probably actually benefiting from this and sort of getting in on the trade. And perhaps maybe when you look at these stocks now, significantly off their highs of the day, maybe already getting out of the trade, right? Because the stocks move pretty quickly. And the other thing too with that is investors maybe have just gotten a little bit smarter too. We're not seeing the level of leverage in the market that we saw at a time like 2021, or we saw in prior bubbles. This is something that we've been talking about a lot in the bubble conversation that for some reason we started having over the last 2 months. But capital economics kept pointing to leverage in the market. And there's this graph you see, leverage in the market usually shoots up around the dot-com bubble. It shot up around the great financial crisis. And it even shot up in 2021 about in line with where stocks are. Here's the chart here. Your purple line there, for a high level, we can call that leverage in the market or people using margin to trade.
Right.
And that is not nearly as closely correlated as the S&P 500 chart. And so when you take a look at that, it basically is just telling you that level of risk that people were taking in prior moments isn't quite happening right now.
Good.
Really interesting.
Probably good, yes. Probably overall a good thing, I think, for everyone involved.
Thank you, Josh. Appreciate it. Moving on, Google parent Alphabet stepping up its game in the generative AI battle across its businesses. Dan Howley is at the Google I/O Developers Conference in California with more. Dan.
Yeah, Josh, we're here at the Shoreline Amphitheater. Sundar Pichai took the stage here to kind of unveil everything that Google is doing when it comes to AI. And I basically can say that it's everything. I think the biggest announcement here, though, was the fact that they're bringing generative AI into search. Now, they've been playing with this a little bit on the back end. They have a feature called Search Lab that allows you to try these kinds of features out. I've been using it for a while. It is generally helpful, but now they're rolling it out to everyone in the US. And then globally, I think they said they'll have about 1 billion people using this. It really is a fundamental change to how Google search works. It's its biggest, most lucrative product. So it's going to be a big risk. If it does pay off, though, it could put them further ahead of anyone else in the category. Yes, Microsoft has Bing. Yes, they were trying to cut into their market share. No, they have not. We also know that OpenAI may or may not be working on some kind of search engine option. It's still up in the air at this point. So for now, Google is really showing off that it's still the king of search, and it's building on that as well. And then beyond that, there were a few updates to its Workspaces app, that would allow you to do things like have a meeting recorded, and then if you're not there, you can get a summary of it, which is, I think, something that everybody wants. And then to Android, getting a number of generative AI features. Talk about generating images, a spam kind of feature where if you get a phone call and it's someone trying to get you to, I don't know, change your bank account number, the generative AI will be able to listen to that and then tell you it's spam and to hang up. And just, so you're aware, that's not going up to the cloud. It's going to stay on device. So Google says that they're not going to be listening in on your conversations.
Dan, I was telling the team, I think I saw fish at the Shoreline Amphitheater back in probably the 90s. I didn't know that's where the event was happening. When it comes to this new assistant, the digital assistant that Google's talking about here, there's also a lot of competition on that front. I mean, from what you've seen today, because you said it remains to be seen whether Google's going to win or one of the others is going to win, and when it comes to search and some of this other stuff. I mean, how impressed with you were with the technology that you saw today?
Yeah, I mean, you're referring to the Gemini Live, which is basically GPT 4.0. They're essentially doing the same thing, and you got to figure that OpenAI knew about that, so they were like, well, we're just going to one-up you guys by coming out the day before, and that's exactly what happened. So, if you looked at one demo for GPT 4.0, and then you looked at what they're doing with Gemini Live, it's still a lot of the same. That said, it's incredibly impressive what they're able to do with this, where, you have your camera and you're basically talking to an assistant that's able to see what's going on around you. And one of them, a woman was just kind of panning around her office, asking questions about the office here and there. She had moved the camera over her glasses, never mentioned it to the assistant, and then later on in the demo said, "Where are my glasses?" And it was able to say, "Oh, it was by the Apple on your desk," and sure enough, that's where it was. So it's intelligent. It's got this contextualization that it's able to do, and I do think more users are going to be jumping to a Google product first. But with ChatGPT, OpenAI really proved that they're able to marshal a huge audience of people who are interested in this new cutting-edge tech. So they may have an advantage there. I think really it's going to come down to between OpenAI and Google. Microsoft, yes, uses OpenAI. Yes, they have their co-pilots everywhere. But when it comes to something along the lines of search, it's still going to be Google and then OpenAI's potential threat. I think more so than Microsoft and Bing.
Dan, thank you so much. Really appreciate it. And we've got another tech trending ticker to check on, and that's Oracle. Those shares are getting a little bit of a lift today after the information reported that Elon Musk's AI startup, XAI, has been in talks with Oracle about spending $10 billion to rent cloud servers. Now, we knew that the two parties were in talks. Larry Ellison used to be on the Tesla board, remember, so he has a connection with Elon Musk, but we didn't know how much this contract potentially would be worth.
Yeah, I mean, Ellison has talked about, listen, Ellison and Musk are close friends, so they know one another well. A couple points I would just make in this story. I know the stock is popping, but it does look like this story is based on one source, so I just want to highlight that for viewers. The other immediate question I had was whether XAI really has $10 billion to spend. I mean, I don't know. Maybe. I mean, there are reports that the company's in talks to raise billions out there. Listen, Ellison and Musk are close friends. Reuters actually reminded me, and I had forgotten, that XAI did sign a contract back in September to train AI models in Oracle's cloud. So who knows? Maybe.
Well, and the other interesting note in this report, by the way, is that in the recent reports about XAI raising money, Oracle may have been part of that funding round.
Yeah.
So they're funding the company, but they're also a customer of the company.
Yeah, I mean, if you're in Oracle, obviously this is exactly why you're in the name, because you're betting on exactly this kind of traction and momentum in the cloud business, so you can get the excitement.
Well, we'll look for some sort of confirmation if this is actually happening. Coming up, as the U.S. ramps up its tariffs on Chinese goods, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Stay tuned, more market domination on the other side.
President Biden targeting strategic sectors with new tariffs on $18 billion worth of Chinese imports. Here's what the president had to say to Yahoo Finance's Brian Sozzi on China's potential response.
Well, I'm sure China will talk a lot about it, but the fact is China already is what you might say way over their skis on this. What they'll do, I don't think it'll lead to any international conflict or anything like that, but I think they'll probably try to figure out how they can raise tariffs maybe on products that are unrelated.
As the U.S. amps up its tariffs on Chinese goods, we're looking at how to navigate the big picture with the Yahoo Finance Playbook. And joining us to discuss is Anthony Sassine, Crane Shares Senior Investment Strategist, along with MacroLens Chief Strategist Brian McCarthy. Guys, welcome both to the show. And Brian, I'll start with you. I like this headline on my colleague Rick Newman's column today. Trump called himself a tariff man. Biden looks like one too. Big picture, Brian, walk us through kind of just your reaction, your response to the news today.
Yeah, that headline is the political objective for sure. But I think we need to keep perspective from a sort of a macro standpoint. 18 billion, we're talking total imports from China, well in excess of 400 billion. The Trump tariffs on 300 billion of those imports were left in place today as well as part of a long-awaited review of his tariffs that's been 2 years in the making. So, this is a marginal hit to China. I think the president is correct that they're unlikely to respond. And really, if you look at the RMB, which hasn't moved much at all, Chinese equities really haven't done anything the last few days when we knew this was coming, it really tells you that it's more style than substance as far as the macro story goes.
And so, Anthony, if that is the case, first of all, do you agree that it is more style than substance? And of the two countries, where do you think more of an economic impact would be felt?
Absolutely. It's more style than substance. And, as he says, President Biden said, China will raise tariffs on unrelated products. That's exactly what he did, right? 18 billion out of 450 of imports. But this is disappointing, right? It's hard to see things like that happen in the U.S. in the 21st century. We're supposed to be in an open economy, in an open world, capitalism, actually the U.S. cheered China when they helped the manufacturing industry back in the 2000s when they were producing cheap products for the U.S. consumer. So I think that's what's going to do. It's going to hurt the U.S. consumer more than anybody else. And I agree that there needed to be something to be done for the people who live in Pennsylvania and Michigan when we had this transition 12 years ago. But today, taking these drastic measures, I think it's going to hurt the consumer. It's going to delay climate policy and probably increase tensions with China. And, basically the solar industry in the U.S. is non-existent. You see 179 gigawatts of installation versus 3,000 gigawatts in China. It's a little bit of a joke, and that's going to continue, unfortunately.
Brian, I want to bring you back in here. You agree with Anthony's point there that this is going to end up actually negatively impacting, hurting the American consumer?
I would say it's always suboptimal when you have to do something like this. But for many, many years now, we've tried to get China to play by the established rules in this game of international trade, stop the forced transfer of technology, stop these heavy subsidizations of chosen industries, stop their hidden protectionism, non-tariff barriers to our companies. And I think because China has steadfastly refused to make any of those changes, the simple reality is if we don't want to decouple with China, we want to continue to trade with them. If you place national security or national economic security importance on an industry, you're going to have to protect it in some way, because if China decides they want to dominate it, they will dominate it because they play by a different set of rules. So I wish we weren't here for sure. But after many years of trying to get China to play by the rules, this is what it's come to, unfortunately.
So, Anthony, let's get to what people should be thinking about from an investment perspective, right? So if you're looking at Chinese stocks, as you do, Are there any sectors that you think could be benefiting or be hurt by the specific announcements today?
Yeah, I don't think anything has changed from the Chinese perspective. I don't think one analyst on the street have, baked in any one penny coming from U.S. For electric vehicles or renewable energy or even semiconductors. So that's not going to change much. On the U.S. side, that's going to benefit more. I wish it's going to benefit Ford and GM, but unfortunately it's not. It's going to benefit more Hyundai and Toyota, because these guys have much better cars in the US, especially on the EV side. It will benefit Tesla. And we're also seeing some of the charging company and the hydrogen companies up 20% today. And also it's SunPower, which is, I think, one of the meme stocks. 95% short interest today is up 50%. First Solar could benefit from this too, because now it's an open market in the US, despite higher rates and lower solar installation. But from the Chinese perspective, that's not going to impact anything, and Chinese stocks continue to be lucrative for the long term with the cheap valuation and low positioning at this point.
Brian, get you back in here for a question. I guess this question, Brian, it's not a near to intermediate term, but I am curious whether long term, Brian, you see news like today, whether you think we are here on a path to decoupling long term, and if so, Brian, what does that actually look like to you?
Yeah, well, it's hard to see any of this stuff going in the other direction. So it certainly appears to be a one-way ratchet of increased barriers to transactions between the two economies. I think the bigger question that Chinese stocks are going to have to wrestle with in coming months, if the polls continue to look like we have a tight race in November, is it possible that Donald Trump gets reelected and comes in with something really more stark and more substantial in terms of something that could put us on a decoupling path? And I think if you look at what Janet Yellen said, she was in China last month. I think she probably told them this was coming. They've really tried to manage the relationship. So these moves today, they're sort of going to keep that contained. Neither side under present leadership wants to see a broad decoupling get underway. It's unclear whether Donald Trump really has the stomach for that, because you would certainly send the globe into recession, if not depression, if we actually took some of the steps he's talking about. But again, a lot of uncertainty there, and I think that's really going to come to the fore for markets at some point this summer.
Brian, Anthony, it was great having both you guys on the show today, helping us think through all this. Appreciate it.
Thank you.
Thank you.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
And that's the closing bell on Wall Street. And now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session, sponsored by Tasty Trade. I'm going to start with where the major averages ended up. And up is probably the operative word here because we see the highs of the session for the Dow up about 126 points, about a third of 1% here, but really ticking up in the last hour or so of trading. For the S&P 500, similar, although a little bit less dramatic leg up there, up about 0.5%. The Nasdaq up about 0.75%. As we've been discussing today, there's been real outperformance with the Russell 2000 as well, perhaps helped in part by this sort of resurgence of the meme trade, maybe part of what is going on there. And we're also looking at what's going on in the bond market, a little bit of relief on yields, also not hurting matters. Jared, what are you seeing?
Well, I'm seeing broad-based strength in tech. And let's go to the Wi-Fi Interactive. I will show you the sector results for today. Tech closing the day up about 89 basis points or 0.9%. Only two sectors in the red, industrials and staples, and not far in the red. The other winners here that are outperforming today are real estate and financials, both interest rate sensitive. So that's a theme we've been tracking as well. Now, here's our leaderboard, an interesting mix of leaders. We have XRT, that's a retail ETF. It's up almost 3% in the upper left, followed by cannabis, solar stocks. Then you get ARC, so unprofitable tech, then chip stocks and IPO, regional banks, etc. To the downside, Bitcoin was the biggest loser, down 2.5%. Also, Chinese stocks taking a little bit of a stumble and not a whole else lot moving. I thought we'd take a look at Chinese stocks real quick. That's one of the few red boards you're going to see today. But if you want to see some green, let's take a final look at this meme stock board, guys.
Some green, not as much green, perhaps, or not as big gains as we saw yesterday.
We can do the two-day total.
The two-day total,
there
then we're going to see some bigger gains, perhaps, at least for some of these guys. Thanks a lot, Jared. Appreciate it. GME up 183% over the past 2 days. Well, markets closing higher today. The big economic data point today, another hotter than expected inflation report, this time on the wholesale side. Producer prices rising more than estimated in April, comes ahead of tomorrow's CPI consumer price print. For more on what that means for investors, let's bring in Bryant Van Cronkite, portfolio manager at Allspring. Thanks for being here, Bryant.
It's a pleasure. Thank you.
So this is not the relief that people were hoping for, perhaps, on the inflation front today. But I know that CPI is seen as more important in the eyes of the market. But how are you sort of weighing the PPI report?
Yeah, under the covers, the PPI report was more benign than maybe people feared on the surface. So I think it's a good sign for maybe people who are worried about inflation staying sticky. In the market, I think moved higher than that today. But there's a lot of pressure on the CPI tomorrow. Right? I think the market clearly is hoping the Fed can jump through that ever-closing window with a prospective rate cut. But inflation has to cooperate. And every data point we have going forward is one more chance for that window to slam close on them. So tomorrow's a big day. The market could be volatile around it, and we'll see what it has in store for us.
And Brian, are you in the camp that confident that actually inflation, the trajectory of it, we do get back to Jay Powell's target and he is able to cut this year?
I'm actually concerned we're not going to get there at the pace the market thinks we're going to get there. I think inflation could stay sticky, largely because the problem here is the employment situation. Both the quality and the quantity of labor is not meeting the needs of the small businesses and large businesses and what they need to drive their businesses forward. And so unless we see that employment situation get fixed, I think inflation is going to stay a little bit sticky right now. The only thing that could maybe change that, in my mind, is the consumer weakening faster, putting pressure on GDP, putting pressure on the economy, but that's not a good situation. But that could be our reality.
Right. I mean, that's what we've always heard from people over and over again. If the Fed is cutting for quote unquote good reasons, right, then the market can still go up. If it's cutting for quote unquote bad reasons, there's too much slowing.
They'll be judged not by what they do, but in which context they do it.
Right.
And if we're seeing GDP dropping, unemployment rising, the market's not going to care that they've cut. They missed that prospective window. Now they're reacting, and that will not be a good thing for markets.
So on the consumer spending side, are you seeing concerning signs? It seems like we're hearing sort of anecdotally from companies that they're seeing a little bit of weakening.
The consumer's been remarkably resilient for much longer than I think most of us anticipated, certainly more than I anticipated. But our channel checks this week even show it slipping further and further up in the income cohort. So it started out as maybe the lowest end consumer, starting to make tough choices, trading down to more value categories, moving into private label. We're now hearing just this week that a lot of our grocery channel checks, our restaurant channel checks, even the retail, that consumer is now the $100,000 household, which it's moving up now. And as it moves into the middle income, that's when things get a little bit more dicey for me. So I'm getting more and more concerned in the last week or two.
I'm interested, Brian, we've been talking a lot on the show today, Biden imposing these new tariffs. Now, obviously, a big part of that is it's just raw politics, right? You're trying to win votes in key swing states. It brings the election kind of back in focus. How much are your clients asking you about that right now, Brian?
Well, they recognize that elections bring volatility, but ultimately a lot of what we're hearing today is more politics, less economics, right? The tariffs impact about 8% of the imports from China right now. That wasn't a huge news event. Clients are just worried about what's the plan going forward, right? The regulatory backdrop for a lot of industries matters. And it seems like whenever someone else comes into the White House, we cancel everything we just did the last 4 years and start again. And that's frustrating for investors. It's frustrating for a lot of people in every line of work. And so what people want is stability. They're not going to get it right now. So we're just going to kind of trudge through. And the way to trudge through it is focusing on what a company can control. Our approach to investing is really understanding how a company's financial freedom, as measured by their balance sheet, allows them to kind of navigate any market environment. That's the key for investors right now, is focus on what you can control, use balance sheets to measure that, and then drive forward with your investments that way.
So who's doing the best job controlling right now? Or I guess I can ask that a couple of ways. What sectors are best poised to do that right now? And are there examples of companies that are doing a good job of that?
Well, staying with the consumer for a minute, I think consumer discretionary is a more dangerous place to be. So I would underweight discretionary right now and overweight consumer staples. Consumer staples have been left behind valuation-wise, I think for good reason. Because the consumer has been resilient, because the economy has been stronger than what we expected, people were kind of ignoring the 3 to 4% top line growing staples groups and putting capital elsewhere. We're starting to see that reverse now. And what I'm seeing are names like Keurig Dr. Pepper or Church & Dwight doing a really good job investing through innovation to drive higher market share, drive and maintain higher pricing. That's going to show up as stable and growing free cash flow, even if we see the economy slow down. So I like consumer staples, and those two names in particular, relative to consumer discretionary.
You also like the construction market, Brian, or at least names in that sector?
There's opportunity there for sure. The infrastructure bills got passed a few years ago now, and we've sort of forgot about them. But so much of that money is not just now flowing into the economy. So a name like Vulcan Materials that provides the aggregates that go into roads and bridges and buildings, they're seeing a very strong demand pipeline right now and good pricing. Jacobs Engineering, another company, is benefiting from the CHIPS Act. They're doing a lot of the engineering and design work as companies move semi-manufacturing into the US. So there are pockets of opportunity in construction, in building, that I think are still undervalued because they have long duration on their revenue streams.
Brian, actually, I have one last question for you because, we talk to New York City people a lot. You are based in Milwaukee, and I'm just curious, we talk a lot about the vibes, right? The consumer vibes. And I'm just curious if you see a difference in the Wisconsin vibes versus the East Coast or the sort of bigger media narrative.
I think that the way someone reacts to news is different based on where you live. I have the luxury and the pleasure of traveling the world, and some people in certain locations respond very quickly, and sentiment drives that. In other places, it seems to be a little slower, more relaxed pace. I would say the Midwest is known for a lot of things, and maybe on the investment side, maybe for that longer time horizon, right? Mm-hmm. We're not so worried about the sentiment, the short term. We're focused on the long term, and I think that's what differentiates maybe our Milwaukee presence versus some other coasts. But make no mistake, having the ability to work with people, my team is all over the country, having the ability to work with them and understand what you're talking about, because it's a better, more diverse view of the world and what people are thinking.
Makes sense. Brian, thanks so much. Appreciate it. Well, coming up, shares of Alibaba trending lower today. We'll speak to an analyst on the other side about that company's latest earnings. Stick around, more market domination over time still to come. Let's get you up to speed on the action from today's session, sponsored by Tasty Trade. I believe we did see a record close for the Nasdaq today, but not for the Dow and the S&P 500. Just verifying those numbers. But you heard our Jared Blickery earlier talking about the broad-based strength in tech today, and indeed we saw that outperformance of the Nasdaq.
All right, taking a look now at shares of Amazon as Adam Selipsky, CEO of Amazon Web Services, is stepping down from his role after spending 18 years in AWS. Selipsky noting he is taking the opportunity to spend more time with family and says the future is bright for Amazon. Similar sentiment he shared when speaking with Yahoo Finance earlier this month on our Opening Bid podcast.
We're optimistic about the business outlook for AWS, and I think it can continue to grow really rapidly. I don't really see an upper limit on it. Of course, it's not our birthright. It's not guaranteed, and we'll only be as successful as what we do tomorrow for customers.
So interesting, Julie Selipsky, I mean, very well-regarded executive. Interesting career because he was at AWS early days, goes to run Tableau, which sold to Salesforce, then returns to AWS 3 years ago, but certainly helped turn AWS into just a juggernaut. And he was there pre-revenue, of course, now reaching a $100 billion annual revenue run rate.
Yeah, and he was only running the place for about 3 years. Even when he came in, reportedly, I was seeing some reports that some internal executives were surprised that Matt Garman was not then getting the job. He is now getting the job, by the way. He is the one who is replacing Selipsky as head of AWS as of June 3rd. So Garman had to wait a little bit longer, but eventually he ended up getting the position.
Yeah, and the team at Baird actually told their clients today they like Matt Garman in this role. They called him a solid replacement to lead AWS, say that he's well respected both internally and with AWS customers, says he has a strong product background. So interesting. I mean, they obviously now kind of the next, for investors, they want to see Matt now kind of drive growth in AI, Gen AI, sort of reinforce AWS leadership. So it'll be interesting, but he has Baird's full support there, it sounds like.
Yeah, and AWS did perform well last quarter. They did see better than estimated growth there.
That is true.
So coming into a good position. By the way, for that full discussion with AWS CEO Adam Selipsky, be sure to check out Yahoo Finance's Opening Bid. You can find it on our website. You can find it across other platforms, including Spotify, Pandora, and Amazon Music. I listen to it on Spotify, actually. And there you can also find the latest on the Opening Bid. Brian Sazi streaming every Monday and Friday from 8 a.m. Eastern Time.
Shares of Alibaba well in the red today after the company posted an 86% loss in profit year over year. For more on the latest quarterly results, let's welcome in here Angelo Zeno, CFRA Research Senior Equity Analyst. Angela, it's always good to see you. So let's just talk Alibaba there, Angelo, because they report investors clearly disappointed. That stock got hit today, finished down about 6%. Give us your reaction to the report, Angelo. What did you make of it?
Yeah, no, thanks for having me, guys. So, as far as the results were concerned, I think, part of the reason we sold off was we kind of ran into the numbers a little bit, over the last week or so. I'd also say, definitely some disappointment as far as their e-commerce business is concerned, as well as their cloud business. When you kind of look at those two businesses, over 50% of their revenue, that kind of being more their China e-commerce business. So you kind of look at what's going on in the e-commerce side of things in China, continue to see pricing pressure out there. You are kind of seeing improvement in terms of kind of the order volume there. But that said, when you kind of look at the growth of that business segment, only growing about 4% year over year. So that continues to be, disappointing in our view. The other side of things, as far as the cloud business is concerned, that is a critical part of the valuation story, we think, for Alibaba here. That has been a business that has disappointed here investors over the last several quarters. You look at the growth rate here again, low single-digit growth. That has been the theme here over the last 4 or 5 quarters or so. So really kind of, they did highlight an improving trajectory later this year, but that said, we're not seeing it in the results at this point in time, and that continues, we think, to disappoint a lot of investors out there.
Yeah, and Angela, one of the things you highlighted in your note is that you've got the Chinese government sort of hovering over the company. What do you think what risks specifically do you think they pose at this point?
Yeah, I mean, as far as the government can, whether it be the Chinese government or even the U.S. government for that matter, I mean, there are clearly geopolitical pressures out there, to be honest with you. And I think the biggest risk is we just don't know, what could potentially happen out there from a geopolitical side of things. What kind of initiatives can be announced in the future. But that said, they are absolutely in the eye of the storm here. When you kind of look at, some of the pressures that they're facing, clearly their inability to kind of have access to certain advanced chips out there is definitely going to hinder their ability to kind of create the large language models out there that could potentially generate significantly higher revenue or the type of capabilities that you see from their U.S. counterparts here. So, there are a number of issues out there, that they face from a geopolitical perspective. And, one thing I would highlight here is the fact that they also did announce that they're going to kind of revisit the fact that they were going to move their primary listing, I believe, to Hong Kong, later this year. And I think that's interesting because I think, there are clearly concerns out there, or were concerns out there back in, 2-3 years ago about a potential delisting and implications that could have to investors out there. But the fact that you are kind of, shifting your primary listing out there also, I think kind of, if something were to happen, from their U.S. listing here, allows them to continue to have that listing, overseas.
Angelo, I'm just curious, how good a read, in your opinion, is Alibaba on the Chinese consumer? And if so, what did this earnings report kind of tell us about the health and resilience of that consumer right now?
Yeah, I mean, and I think you're getting, different views from, different companies out there. But, at the end of the day, you kind of look at these results here. I mean, it definitely tells you that the consumer is trading down. That has been kind of the story, at least on Alibaba's side of things, the last couple of quarters. But that said, again, I mean, the volume looks like it's improving when you kind of look at the tea leaves from a number of end markets out there, whether it's, certain areas I cover kind of more on the tech side of things like smartphones. You're definitely seeing kind of, improving prospects on the China side of things. Now, whether or not that is sustainable as we go into the second half of the year and into 2025 remains to be seen. But as far as this quarter is concerned, we've definitely seen some improvement from the China consumer out there.
Angela, I want to switch gears because today Google holding its I/O conference, right, introducing some new AI-powered search capabilities as well as Gemini capabilities. And I know you cover Alphabet as well, so I'm just curious, what you thought of what they announced and whether Alphabet is successfully making a case that it is going to be one of the big leaders in AI.
I mean, we think so. When you kind of look at what they announced here, a lot of it very incremental in nature. I'd say kind of maybe the biggest news was maybe the fact that they're going to start featuring AI overviews by the end of this week in the U.S. And then, in the coming months, you'll see it on a global basis. But AI overviews, essentially kind of AI-powered summaries out there when you look to do a search out there. So they're throwing kind of more AI capabilities across their search business. It's something, they've clearly been in beta mode here over the last couple of months. They're now kind of, going full gear into it. And I think that's a good thing. I think that kind of, showcases them kind of, again, looking to kind of get more AI enabled out there in a very, very sensitive area and an area of their business that could potentially be disrupted over the next couple of years. And then, they also kind of announced a number of kind of, model upgrades with Gemini and 1.5 as well as Flash. So and then we also saw a number of improvements on the Android side of things that they could potentially launch here as the year progresses. So incremental improvements is how I would kind of look at what Alphabet is doing here as far as AI is concerned. But our view also is kind of what they're doing on the infrastructure side of things. What they announced at Google Next last month kind of shows really they are best in class on that side of things. So we do like the incremental improvements as well as their kind of best-in-class infrastructure out there.
I'm just curious, Angela, we also just heard from, Sam Altman and his team at OpenAI. If and when OpenAI launches their own search product, Angelo, and that's been reported on, what kind of competitive risk do you think that poses to Google's bread and butter search business?
it's definitely a risk out there. I mean, we did write a note about it yesterday, and it's kind of wait and see, and we kind of have to see exactly what they roll out with and how they roll it out. I think it'll also be interesting to kind of see what Apple has to announce next month, and whether or not they strike a partnership with OpenAI and how that kind of looks across their ecosystem. But the way we look at it is Alphabet continues to be that ultimate consumer company out there, and they are essentially the internet in many respects. So could they potentially see some disruption across their business model? Could they potentially see some share loss? Of course they can. And in fact, we anticipate it to some extent, but in the same respect, they've also got a number of opportunities across other parts of their business, specifically, areas like the cloud. So we do continue to like the story. We do think they will continue to, be fine on the search side of things with some share loss. But that said, OpenAI is a formidable competitor out there, and it will be definitely interesting to kind of see what Apple has in store here with partnerships that they announce, whether it be with Gemini on Alphabet side of things or OpenAI. So wait and see.
Wait and see. We got a lot of big tech news coming, Angelo. Thank you so much for joining the show. Appreciate it.
All right, thanks for having me, guys.
Time now for To Watch Wednesday, May 15th. Starting off on the economy, the latest consumer price index data is coming out tomorrow morning. Economists forecasting the April report to rise 0.4% from March and 3.4% year over year. It's coming after another higher than expected inflation print today. Producer prices rising more than expected. Recent streak of sticky inflation readings has investors pushing back expectations now of a rate cut to September.
And moving over to the Federal Reserve, speaking of which, we'll be getting another round of Fed commentary tomorrow from Minneapolis Fed President Neil Kashkari and Fed Governor Michelle Bowman. Fed Chair Jay Powell speaking today. He reiterated that he expects inflation to fall, but is not as confident about it as he was in the past.
And finally, we're going to get a few more earnings tomorrow, including Cisco, company reporting third quarter earnings after the close. Analysts expecting Cisco to get a boost in sales from its acquisition of the software company Splunk back in March, but also anticipating demand in its core networking businesses to remain weak.
And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But stay tuned. On the other side, we'll hear from U.S. Trade Representative Catherine Tai, who spoke to our Brian Sazi about the new China tariffs. Stick around, more Yahoo Finance on the other side.
Jesse, thanks so much for joining Yahoo Finance. We appreciate it.
Thanks. Glad to be here.
So the president has come out very strong. New tariffs on certain sectors. Tell us how China's practices have impacted your business and your industry.
Yeah, I mean, there's a very good example. So since the year 2000, the Chinese produced 5% of world aluminum at that point. Today, they produce over 60% of the world's aluminum. That same time period, US had 25 smelters in 2000. Today, we're down to 4. So this massive overcapacity fueled by sort of unfair trade practices from the Chinese side has had this direct impact on US aluminum production.
Sounds like a potential national security issue if we only have, what, 4 smelters in this country?
That's right, absolutely. And aluminum is in everything. I spoke about it a bit today. It's everywhere from foil in your kitchen to electric vehicles to fighter jets to missiles. It's everywhere in modern life. And to not be able to produce it here, it's a major problem.
Now, China said it would take, their response to this, they would take the appropriate actions. What would any actions from them mean to your industry?
Well, not much, to be honest. Here at Century, we're focused on bringing aluminum production back to the United States. You may have seen we just received a grant from the Department of Energy for $500 million to build the first new aluminum smelter in the United States in 45 years. Yes, so we'll have 5. And that will take some time to get done, of course. This hasn't been done in 45 years. But we're super excited because in contrast to what the Chinese have done, our smelter will be green. It'll be powered with cutting-edge technology and renewable energy, which will make it one of the greenest smelters in the world.
Why have these jobs in this industry moved over to China and overseas?
Well, it's really from Chinese industrial practice, subsidies, unfair labor practices, unfair trade practices, dumping their metal onto the world market. That's made it very difficult for Western producers to compete. And so we are very thrilled that this administration has really stood up for domestic manufacturers and is focused on bringing manufacturing back here to the U.S.
What do you think will be the impact on inflation in this country to, let's say, aluminum foil, just putting it right directly to your industry? Do these tariffs bring prices down? And when does that even happen?
Yeah, well, I think one thing to keep in mind is the U.S. is very short aluminum. We don't produce enough. We're down to 4. We don't have enough to service our needs. And from a security perspective, it's very important that we can produce what we need. And we're 4 million tons short on the aluminum side to be able to do that. So we're not even anywhere close to being able to produce our own needs, which is the real focus. And we need to be able to do that from a national security perspective.
I mentioned this when I chatted with the president. Look, the economy has been solid, GDP, unemployment rate, wage gains. Do you see that strength in your business?
Yeah, we started to see things turn. I will say on the manufacturing side, we did see some weakness for a period, but things have started to improve earlier this year, and things are starting to look up. So we're excited about what's to come.
Can you compare what the Biden administration has done to what President Trump did? Now, he championed himself as pro-manufacturing, bringing jobs back to the U.S. What did you see?
Yeah, I would say we've been thrilled with what the Biden administration has done. This focus on reshoring manufacturing has led to direct investment from both Century and others throughout the U.S. economy. And I think what you're seeing, just more broadly to speak to that, is that everyone realizes that in order to be secure, in order to have economic security and national security, we need to be able to produce these core critical minerals at home. And we are ready to be a big part of that.
As a key leader, we're coming up right against the election. Are you planning your business differently or preparing for potential outcomes that may not be so good for the country?
No, I mean, we're very bullish on the United States. We wouldn't be announcing the first new smelter in 45 years if we weren't bullish on the United States. We think this is a great place to do business. We think we can make a product that will be consumed here in the United States. We can offer shorter supply chains to our customers. And so we're just excited, and we're moving forward with full steam ahead and excited for what's to come.
What does the next decade of job creation look like for the aluminum industry? Do you see yourself building that 6th smelter at some point?
Yeah, we hope so. I mean, we hope to get the first phase of this new smelter done, and then we hope to expand it after that. I mean, we've already said it will be 1,000 new jobs at this one smelter alone. We'll double the size of the U.S. industry in and of itself. So we'll start with that, but we definitely have expansion plans beyond that.
You know, I've talked to a couple of my contacts in the chip making industry, and they're opening up really big, bold, new, shiny facilities to make chips in this country. But they're saying it's hard to find jobs. Is it hard to find the labor you need for that smelter or another facility that you may want to open?
Yeah, we've got a great workforce. You know, we've run smelters in this country for a long time. Our workers are highly trained, highly skilled, and we pay a living wage to our workers, very good wage. And so what we found is if we invest in the community, we tend to be able to find the labor force we need in order to run the smelters. And that's what we'll continue to do.
All right, we'll leave it there. Jesse,
Okay.
Thanks so much for making time for Yahoo Finance. We appreciate it.
Thanks, Brian. Pleasure.
The meme stock rally is back again, and our next guest has some thoughts on how to play the meme trade. With us today is Sean McLaughlin, Chief Options Strategist at All Stars Charts. Sean, it's good to have you on the show. One question I had for you, Sean, just to start things off, is I'm interested in whether we have line of sight, Sean, into sort of who is driving this. Is retail traders, hedge funds? Is it a mix? What can you tell us, Sean?
Well, I mean, we know from the last time, 2-3 years ago when we had the first meme stock run, that was definitely kicked off by retail investors. This time, it's not so clear, at least in my eyes. There's definitely retail trader participation, but now that we have, let's call it a playbook for how this plays out, I would assume that there are a lot more deeper pocketed players involved in this move, for sure.
Yeah, I mean, that's something we were sort of talking about earlier, that it's not just the retail traders, it could potentially be hedge funds and others as well. How is the options trade feeding into all of this, and maybe how does it differ from what we saw back in 2021?
Well, as we know, options volumes, especially for retail traders, have exploded over the last 5 years. This is not new news. With the introduction of zero DTE options, of course, that brings a whole new level of interest in options. And what tends to happen, especially in these meme stocks, where you get a lot of retail interest and a lot of people chasing hot money returns, when you get players using call options, for example, to express their bullish bets, well, who's on the other side of those trades? That's generally market makers and dealers. They're shorting calls to sell them to the retail investor, right? Well, they're not in the business of taking directional risk. They want to be as delta neutral as they can. So as they're selling calls to the swelling demand out there,
the only way they can hedge their position, or the best and easiest and most efficient way for them to hedge their position, is to buy stock. And that naturally just drives further demand for stocks, rises, drives the prices higher, and it just feeds on itself in a feedback loop.
Right now, Sean, the names we've been talking about, GameStop, BlackBerry, AMC. I'm just interested, Sean, when you track, the call volume, the volatility, any sense, Sean, of whether, it's gonna stay in these names or is it gonna move to others?
I have to believe that it will move to others. I don't have any particular insight on where it's going to go. Certainly, we have to keep our eyes on names that are heavily shorted. Certainly, those are ripe candidates. But right now, it's the old names that are the playbook. But this all got kicked off by the kitty guy. I forget his name.
Roaring Kitty.
Roaring Kitty, correct. It all got kicked off by him, but he never specifically mentioned GameStop or AMC or any name. Maybe everyone's misinterpreting what's going on here, and maybe he's got a new company he's been researching, and that's going to be the focus going forward. Who knows? It's a wild west that we're operating in here, but it can be fun, and certainly as traders, we enjoy volatility. That's the bread and butter for us to make money. So, hey, if it brings more volatility to the market, bring it on. Let's play.
It does feel fun this time. I guess it's fun until it's not, right? It's fun until you lose the money that you've put into something. And certainly these stocks are still way down from where they were back at their peaks. But Sean, that sort of like cycle that you described a few moments ago about when there are a lot of uptick in call option volume, and then you have the market makers, for example, buying the underlying. What tends to bring a cycle like that to an end?
Well, sometimes there's a change in the narrative, right? We saw that last time around. I think buyers typically exhaust themselves, and especially if people are driving this rise through the options market. The options market is kind of the tail that's wagging the dog. What ends up happening is the premiums in the options get so expensive that, it becomes just such a hard gamble that you're paying so much premium that you really need an even bigger move from where you already are to see a realistic payoff. And at some point, cooler heads prevail and say, this is too much. These are too expensive. I'm not buying here. And that's when you see, buying power kind of evaporate. And then you see the pullback that maybe exhausts itself.
We'll see if that happens until another drawing gets posted of someone leaning forward in a chair. Sean, thank you so much. Appreciate it.
Thanks for having me.
Well, the Vitamin Shoppe is throwing its hat in the ring for consumers looking for weight loss solutions. The omni-channel specialty retailer making its first ever telehealth partnership with the rollout of its GLP-1 program. Joining us with more, Vitamin Shoppe CEO Lee Wright, who's here with us in studio. Thanks for coming in.
Thanks for having me.
So everybody is crazy for these GLP-1s, obviously. We've been talking about it a lot. And so did you all say, well, we want a piece of the action? Or how did this come about?
It's a natural question. Clearly, there's a huge demand out there, but the Vitamin Shoppe has always been a destination for wellness since 1977, our founding. So we're incredibly excited to actually go into, it's a natural evolution into offering telehealth. And the first need state that we will satisfy are the GLP-1s for weight loss medication. But ultimately, we plan on going further and offering other need states, whether it's low testosterone, hormone replacement therapy, smoking cessation, allergies, et cetera.
Are you confident you're going to be able to secure enough supply of those GLP-1s?
Well, we're incredibly lucky. We have a great partner in WellSync. It's our telehealth partner. They have a strong network of pharmacies, and whether they're retail, mail order, or compound pharmacies, we feel pretty confident that through that various network that we can supply that demand.
And so how is this going to work for customers? And do you expect it to be existing Vitamin Shoppe customers who come in and then know that you have this service? Or will you get new folks in the door?
It's a combination of both. We're incredibly excited because we actually did do a study to see how many customers would want to use a telehealth service from the Vitamin Shoppe. And we had over 40% of customers and respondents say that they would like to have a telehealth service from the Vitamin Shoppe. And of existing Vitamin Shoppe customers, over 80% said they were very likely to use a telehealth service. So we think we'll get a combination of both. And the reason why is the Vitamin Shoppe is a trusted resource. It's not just you're going to get a GLP-1 drug for weight loss. You're going to think about a holistic solution to your weight loss journey because we're going to match it with expertise and education as well as nutritional supplements that can fill in those gaps that you may be having when you're in a calorie deficit if you're on a GLP-1 drug.
And Lee, let's say you're a Vitamin Shoppe customer, you're interested. How much does this actually cost?
So we have a variety of options. We offer the brand name drugs such as Ozempic, Mounjaro, Rybelsus, as well as the compound semaglutide and tirzepatide. But it's as low as an introductory rate of $219 a month, and then from there on could be $269 a month after that first month. But the great news is it's cancelable at any time. We don't lock you in for a long term, and it's really just that's all encompassing. So you get all the education resources. You're not paying anything extra. We're just focused on the actual drug itself, and the education, the resources, and expertise of both our health enthusiasts in store and online is free, as well as helping people with their nutritional supplements they should be on if they are on a GLP-1 drug.
Now, Lee, you guys are not a public company anymore. You got taken private a few years ago, but can you tell us anything about what kind of sales bump you might expect from this, or what kind of financial situation you'll get out of this partnership?
Well, we're incredibly excited about it. We do think it will be a material bump in our sales because, again, it's that natural evolution. We're expanding the ecosphere of what the Vitamin Shoppe offers to both existing and new customers because we've never been thought of as someone that will actually provide medications through a telehealth partner. We've been thought of as, hey, natural supplements and nutraceuticals. So it's really a large expansion of our business.
And Lee, you sort of have an interesting line of sight into the consumer. So I'm just curious, like more broadly, how the consumer looks to you. How does the economy look to you?
I think we are seeing a consumer that is a bit strained right now. They are feeling pressure. They're looking for more value. So we actually did do a launch of what we're calling our price shred and end cap of lower price and lower serving sizes. And we're seeing a large response of consumers, I think telling us that consumers are feeling their budgets being constrained right now.
Interesting. Lastly, on the telehealth piece, I just wanted to ask, since we have some big companies pulling back on their either in-house healthcare offerings like a Walmart or telehealth. It's interesting that you guys are making this move at a time when we are seeing some other companies pull back. Are there any sort of lessons learned from what you've seen elsewhere or ways that you're doing it differently?
Well, I do. I think it's a natural evolution for us because we are a destination for health and wellness. For others, whether they're med spas or other retailers, that's not their natural space, is just health and wellness. But for the Vitamin Shoppe, that is our core area of expertise and providing that quality, innovation, and expertise for our customers. So we think we can provide that holistic and long-lasting solution for customers to have their lifelong journey of weight loss or whatever health they're looking for.
All right, Lee, thanks so much for coming in today. Appreciate it.
Thanks for having me.
Coming up, Comcast, the latest to announce a new streaming bundle. We're going to tell you about it on the other side. President Biden responding to China's trade practices with increases to the tariff rate on strategic sectors. Yahoo Finance's Brian Sazi had the chance to speak with the United States Trade Representative, Ambassador Catherine Tai, on the latest move. Here's what she had to say.
So talk to us about the measures that the Biden administration took here. How do you expect China will respond to this?
Well, this shouldn't come as a surprise to China. In all of our engagements with China, certainly recent engagements, but going back the last couple years, the administration has been very, very clear about the challenges that we are having in the U.S.-China trade and economic relationship. And it is because of those challenges that we are taking the actions that we are taking today.
Jared Bernstein, we had the opportunity to talk to him, and he suggested that China might respond in kind, so $18 billion of tariffs on China. Do you think they respond in that way?
Well, Jared is a very smart economist. I'm just a lawyer. I can't speak for China, but I do know that everyone will be watching what China does, and what China does will potentially reinforce the reasons for our taking these measures, which is a history of anti-competitive and unfair trade practices. In this particular case, intellectual property rights abuses, including outright IP theft, forced tech transfer practices, and overall non-market practices, industrial targeting, that have had significant negative effects on the U.S. economy, on our workers and our businesses.
I think the average investor that comes to Yahoo Finance, they're not familiar with the nitty-gritty of how unfair China may be in their trade practices. As someone that has been doing this for a long time, how unfair are they being?
They're significantly out of step with the norms, the standards, and the rules that the international trading system has been built on, which is one that assumes and expects that markets and economies will behave on the basis of the logic of demand and supply. Instead, what we've seen from the PRC's economic policies and practices is a sustained and very targeted approach at establishing industrial dominance in sector after sector, whether it's steel and aluminum, solar, batteries, now we see electric vehicles. And what results is predatory prices that drive other producers out of the global marketplace, creating an extremely high level of concentration and dependence of the rest of the world on Chinese production and supply. It has gotten to the point where it's frankly untenable, both because we've seen China's willingness to weaponize that dependence when a trading partner does something politically that China finds that it doesn't like, and also in cases where a natural disaster, extreme climate event takes place, and when you are that dependent on one country for supply, and that country is knocked offline in terms of supply, the resilience of the supply chains we've seen around the world at this point is very low, and we all end up paying the price for it.
Why semiconductors?
Semiconductors are at this point in everything. If you just look around us in this room, almost everything that turns on or off has got a semiconductor in it. Both the really fancy things like the fancy smartwatches, but also in very, very basic things like these lights. And so what we want to ensure is that there is a healthy and diverse set of options when it comes to semiconductor supply, because it has become the lifeblood, the blood cells, if you will, for our modern economy.
Why not just come out and ban EVs from China? Just say that word ban.
I think that our methodology is to be very disciplined about looking at what the threat is and then how to counterbalance it. At this point, our concern is how do we continue to make space for American producers and workers in autos and in EVs to continue to be able to grow and to thrive. So I think that the question really is, what is the appropriate defensive mechanism? At this point, we see that 100% tariff as being effective. I think that we will also have to see how this plays out over time.
What's the read-through from an initiative like this, Ambassador, to AI? China is moving very aggressively with AI and developing AI and other computing technologies. How should investors think about that?
I think that a couple things. One is this is why semiconductors are such a huge part of the conversation, because AI is powered by just energy, but also by that compute power. I think this is also the reason why data and technology and trade have become such a hot issue, because these days the data is the commodity. But in terms of investors, I think that investors should keep very careful track of where AI innovation is happening, and also the value set that is fueling and shaping that development, because it has the power to shape our very realities going forward. And I know it is a very hot area for investment, speculation, and innovation. It is also important for us to stay very, very vigilant.
It's the era of the bundles. Comcast is the latest to announce a new streaming bundle, the new service to include Peacock alongside Netflix and Apple TV+. Yahoo Finance's Alexander Canal joining us here with more. I know I keep making the joke, Allie, but now the cable company is offering bundles. Come on.
I know. And it's been very interesting to cover this space over the past few months, because we've seen more of that. We've seen more bundling. This was something that Comcast CEO Brian Roberts said earlier today. Now, this new bundle, it's going to combo the Peacock platform with Netflix and Apple TV+. It's going to be known as Stream Saver, and it's available to customers of Comcast broadband internet service. Now, we don't have an exact price point yet, although the CEO said that it will come at a, quote, vastly reduced price to anything in the market today. It will launch sometime this month, and we will get more details on the pricing then. But you're right. I mean, right now, media companies are facing pressure from investors to really turn a profit in their streaming unit. We've seen that with some companies, obviously Netflix being the gold standard, and then Warner Brothers Discovery has turned a streaming profit. But for the bulk of other players out there, we have not seen that. And also at the same time, consumers are becoming a lot more choosy about the platforms that they sign up for. We have new survey data that says consumers only want to spend around $60 a month. That only accounts for about 4 streaming services. So the whole pitch here being is that if you can offer multiple services together, that's a good value proposition for the consumer. We'll see if this comes to fruition. I did notice on the earnings call this past earnings season from a lot of these companies, they're all praising each other. It seems like there's a real kumbaya movement. They all want to work together here. And it's sort of because there's this desperation movement right now.
Real quickly, Allie, Disney Plus getting into live sports with like Caitlin Clark's WNBA debut.
Yeah, this just comes as Disney has really been doubling down on their sports offerings. We do know that there's going to be a fully over-the-top ESPN service coming in 2025. This is separate from the joint venture that they're going to be launching with Fox and Warner Brothers Discovery, also very focused on sports. So this makes perfect sense to me. The WNBA's existing media rights deal expires in 2025. They're expected to double their package once those rights open up. And we do know that Disney is in current negotiations with the NBA, and reports say that they are close to nabbing a deal there. So they're very strong on sports, and I think we're going to see that moving forward.
Yes, we'll see, won't we? Thanks, Allie. Appreciate it. Well, that wraps up our show for today. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.